Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and today we're getting an update from Michael Oliver, founder of Momentum Structural Analysis. And Michael, it's always great to have you on the KE Report because you look at technical analysis in a different way through the lens of momentum, not just in price action. And so that gives you a different take on when markets turn and the different momentum that markets have that may not be obvious to people that just look at a price chart on its own. And we haven't talked for a while. It's been a couple of months since we've had you on the show. But as we talk today, it's February the 28th. It's the last day of the week, last day of the month. And we've seen a pullback in precious metals. Pretty good run to start the year. But of course, everybody always freaks out if there's any price decline. So I'd love to get your thoughts on it, not just from the pricing standpoint, but from how you're looking at gold and silver from a momentum standpoint.
Correct. Actually, we got bullish on gold based on annual momentum back in February of 2016. Okay, 2 months off the low. Nothing has altered that annual, very long-term momentum trend assessment on our part. Yeah, there have been big pullbacks during on en route, the upside. In fact, we had a 3-year stall, where gold mid 2020 to actually 3.5 years through the end of 2023, where it went sideways and then but in March of 2024, so less than a year ago, we defined a resumption in the big trend. In other words, after the pause in gold and the correction in silver and in the miners, they went down while gold basically went into a range. We thought that was over. We're headed back up again. And sure enough, after March of last year, we headed back up again. Silver then was 25, 26 bucks. It reached 35. Right now, it's either side of 32. Gold was just above 2,000 for the fourth time, this time for real. And it went, obviously near 3,000. So a nice move. And during that time, in fact, 12 months year to date, gold and silver are up like more than double what the S&P and the Nasdaq are up over that 12-month period. Is there any cheering on the part of the gold people? No, they're still crying and booing every time there's a pullback. What I suggest is a simple price chart for those who are investors and those who are always afraid, the other type of folk. Look at the monthly bar chart since early last year when we came up out of that clump of ink on gold, all 2000 on down. When we broke out of that, look at the number of sharp pullbacks we've had. You just look at it, you could look at a weekly bar chart or a monthly, and you'll see several very deep, sharp pullbacks last couple of weeks type of thing. Covered maybe $150 or so and a decent percent drop. And of course, during that time, silver even has a worse drop, which is typical of silver. But then, of course, silver on the upside tends to outpace gold. So it's a give and take. But look at those and then look at what we're having right now this month, or actually for the last, let's say, 2 weeks of this month. A sharp drop, a little more than $100, which is to say a 4% drop in gold. It's still up on the month, by the way. It's up, I think, about $50 right now as we're speaking. So it's still an up month. But everybody shakes out at each of these breakouts like, oh, that's the end. Oh, we're going to have a major multi-month correction, et cetera. And it doesn't pan out that way. Yeah, you get a pullback, but by the time everybody gets scared, it's time to buy it again. So I've suggested that if you look at a silver chart or a gold chart over the last year, anytime you get a 10% drop in silver, just circle it and buy it, okay? Maintaining a bullish long-term outlook, which recommenced last March. And you'll see you did better than the guy who simply bought and went long. Okay, buy the weakness. It's the good thing to do in the context of the bull trend, which it is. In the case of gold, you can see the other drops over the last year, which were worse than this one. Don't be afraid of the drops. View them as opportunities. There's nothing in this drop that is destroying any major technical in gold. It is merely a drop. And that's my basic broad assessment right now.
Yeah, so it's a buy the dip moment, and it has been each time that we've seen these pullbacks, as you point out. It's been time to come in and buy, and you've actually, as you mentioned, outperformed somebody that just went long and held. So it's actually using volatility as your friend. Now, you've made the point a lot of times that we're still in a structural bull market, but you could see this mirroring other periods of time where we saw a eightfold rise in gold, and you said that $8,000 isn't a silly number. And people hear those numbers and they think back to, a decade or two of prognosticators coming out and saying 5,000 gold, 10,000 gold, which never came to pass. But people
Mhm.
never thought we'd get past 2,000 or even close to 3,000. Now 8,000 doesn't seem so silly, but lay out your thesis for why this pattern, this particular cycle, could match other cycles in that sense.
Well, there are other factors other than gold. First off, gold is money. It doesn't go up. Everything else goes down, is what you're seeing when you look at a gold chart. When you see gold going up, it means the dollar versus gold is going down. When you see gold going up versus the S&P, which it's done over the last year, nicely so, that means the S&P is going down versus real money. Okay. We face a crisis in the major markets and in politics and in any notions of stable institutions. This is not 2007 and 8 prior to the 2009 drop. This is not merely the dot-com bubble top. This is something much bigger in terms of, one, certain assets going down, paying dues for bubble situations, and that'd be the US stock market is one good example of that. India is another, and Japan is another. They're also bubble markets, and they've broken their structures. S&P and Nasdaq right now are toying with breaking our momentum cell structures as we speak, in fact, today, assuming where they close the week. We cover that in our reports, of course. It's been our argument that this up move in gold, which could do what it's done twice before in the past 50 years, which is to say, have an eightfold move from bear low to the next bull high, like 2000 to 2011, 11 years of upside. He went from a low at 260 and a high at 1920, or the 3-year move from the summer low of 1976 when gold had a 50% correction back toward 100 after having seen 200. And it went to 850 by early 1980, 3.5 years later. So it's not unusual to see gold on a logarithmic scale have an eightfold move. And if we had an eightfold move, well, our bear low was 1,050 in 2016. You do the math. So when I throw that number out, it's not really a prediction. It's merely pointing out that, hey, it's no big deal, particularly when you factor in the macro technicals of some of these other markets and the fundamentals underlying them, which will come ripped asunder once certain technical events take over. And as I said, we're starting to do that right now in some of these bubble stock markets. When they break, it's our argument that that money flow will go into the monetary metals. My son did a report about 6 weeks ago, going back to the early 1900s, when the Dow peaked in 29 and dropped to 1932, the 80-something% drop. You couldn't buy gold back then. Roosevelt, got rid of it domestically. But homestake mining, the biggest miner back then, went up like 1,000-fold. Okay. Okay. So it was a place to be. You go back and look at the 1972, 73 peak in the stock market, which collapsed to 74. Gold exploded during that time. It went from 30 something bucks to 200. Okay. Then look at the wasteland in the stock market that prevailed through 1982, where in the mid 70s through 1982, you were kissing your sister for, a decade almost, going nowhere, total wasteland for investors. And yet gold had a massive move from, 100 to up to 1980 peak with the 850. Then go back to the 2000, 2011 move. During that time, the stock market peaked in 2007. Gold started to move up. Stock market, it had a collapse month in October of 2008, meaning a full year off of its high. It finally produced a dramatic down month, a crash equivalent month. And at that point, gold did sort of join in for that month. But basically, it was part of an ongoing uptrend in gold. So gold was a better place to be than stocks during that period. And, we saw that in .com as well. Nasdaq 100 dropped 82% from 2000 to 2002. By the way, it took it 16 years to get back up to that price again. During that time, gold was in a major bull move. So we argue that it's highly likely that when this bubble breaks in the US stock market and others, that we'll see asset flows back into monetary metals. There's an obvious underlying reason for that, aside from historical evidence, and that is the central banks will go berserk. They'll not only cut rates, they'll cut them more aggressively than they'd even planned. And it will not be good news. It will be an indication that, oops, we made a mistake. Something's wrong here. Monetary policy will go easy very quickly, not just here, but in Japan again, Europe. It's a club after all. And when that happens, that is what ultimately drives gold, the degradation of money units. So I think that's what we face right now. So a puncturing of the stock market in the beginning, you don't have to crash it or anything like that. You just shave 10, 20% off of it, and you're going to disappoint the world because that's basically the only asset that the average American retiree, especially, smiles about. Last year, I made 20% in the S&P in my retirement account. You take that away from him, and he really doesn't have anything else to smile about. And that's when you get emotion injected into these markets, fear, and also where do I go? And as I've said, over the last year, especially gold and silver have more than doubled the upside in the stock market. In fact, you can go back 3 years and see it, the evidence as well. So smart money is going to say, hey, this bubble's breaking. I'm going where it's safer. And I think we'll start to see that very soon.
Yeah, such a good point, Michael, that it's really not gold going up. It's really the crash and purchasing power of fiat currencies. And gold is evidenced by it being up in every fiat currency on the planet. It's not that gold is changing, it's on the elemental table. It's just there, it's a constant. What's changing is the purchasing power is falling down. But people love to debate the currencies and they love to look at currency pairs, missing the point that really all things are going up because the purchasing power is going down. But you're saying when we puncture this move in the equity market, in the US equities, that's when you start seeing emotions come in because, again, their retirements start falling. People start getting nervous. When you look at the US equity markets, are you looking at the S&P or the Dow? Any thoughts on where they're at?
Especially, we're focused solely on the S&P and the Nasdaq 100. Why Nasdaq 100? It is the leader index. It led the way up during the dot-com period, after all, and it led the way down. S&P dropped 50% in that bear market, 2000 to 2002. Nasdaq went down 82%. It had been the opposite on the way up. This time around, since 2009, the S&P has gone up 9-fold, which outstrips any prior bull market bubble in the S&P, by the way, or the Dow. But Nasdaq went up 18-fold. So, I mean, it's definitely the leader. So we're watching it. We've already had enough momentum technical breakage in the S&P about a month ago that we think broke its shin bone, let me put it that way. But the Nasdaq avoided it astutely back then. This week, we're trading under our numbers, and depending on where we close today, we'll close the week out at or above or slightly below our trigger number. But when I look at the picture overall, it looks like even if they delay it this week and doesn't happen now, it's going to happen very soon. I think that the first drop is not going to be a crash event. So I know there's a lot of fear among gold people, that this false notion that if stock market goes down, gold and silver go down. And sure enough, over the last few days, as the stock market has gone down pretty good, gold and silver have gone down. And so it validates their false assumption. All they remember is burned in their memory was October of 2008, again, a year off the bull market high in the stock market. You had what can be defined as a crash, which is excess of 30% drop in a matter of a couple of weeks. Like 87 was a crash, 29 was a crash. Those dimensions. It wasn't 20%, it was like 30 to 35% matter of like 10 days. We had one at the COVID event. That was a crash event. But right now, I tend to think that the first drop is going to find support about just short of 20% below where we are right now. The support there won't hold, but I could see it not crashing, in other words. So anybody who's expecting a crash start to this, if you consider 20% a crash, then maybe you'll get it. But that isn't what historically a crash is. But it could be the kind of jolt that really injects fear and emotion into a category that has not injected fear or emotion in a long time. And I think when that happens, that's when smart investors who aren't already in gold, which they should be because the evidence has been there, will start to look and say, this market's gaining more than the S&P by twice, et cetera, et cetera. And I think you'll start to see that divorce occur, where the day-to-day won't be similar, it will be opposite. And I think that will occur once you break the stock market. and generate the fear factor. Then you'll see the divergence where gold goes up, S&P goes down. And I think that's when gold will no longer go up at this two-step, three steps forward, one step back pace. It will go up like 5 or 6 steps, one step back. In other words, it will accelerate. So will silver and the miners. And I think the factor that will cause that, again, is the breakage in the U.S. stock market bubble.
Well, let's talk about the precious metals equities because there is a big belief system that if the U.S. equities are rolling over, since gold and silver stocks are equities, that they'll roll over with them. But then you'd have the inverse of that with gold going higher, and if silver goes higher, how do they fare in that kind of an environment, Michael?
I happen to think that in 2025, the best places to be, and the last few days, of course, tends to say, no, you're wrong. That is the miners, gold and silver miners, not gold, and silver. We measure the spread relationship, meaning the relative performance relationship between silver and gold. And we divide an ounce of silver price into an ounce of gold, we end up with a percent. Right now, silver is about 1.1% the price of gold. If you go back over the last 50 years, this is not a rarity. 20 of those 50 years, silver was at least 2% of the price of gold. So it's not like it depends on some big, huge bull market to get silver up there. 20 out of 50 years, it was routinely at 2% the price of gold. If we go just from where we are now, and we're watching these technicals on a very close-up basis, the spread relationship between an ounce of silver and an ounce of gold, you get silver up about 1.4%. Right now we're 1.1. It's going to surge again. And I think that surge is likely to take us up to that 2% level. Well, what does that say? It says that over the next, I think probably about a year, you're going to see silver double in value in its relationship to gold. So, I mean, even if gold just sat here, let's say at $3,000, and silver went to 2%, it'd be $60 silver. Okay. Well, obviously, you're not going to have silver double and gold sit here. But the point being, you could get a much greater multiple gain out of silver. And I think you're about to. The technicals tend to argue that one, the spread is very cheap and low, and two, it's ripe for a turn. Then when we shift over to the gold and silver miners, we put out a lot of reports recently, but we've shown going back to the 1980s. Now, let me try to explain this. XAU index has been around since then. That's the Philadelphia Gold and Silver Miners Index. It includes silver miners, quite a few, in fact. And it's been around since the 80s, unlike GDX ETF, which has only been around since 2006. So we use XAU. But between the mid 80s and 2008, so for like a couple decades, XAU price was at 17.5% up to 35%. It was a range. So 17.5 up to 30, 35%. That's where its value was in relation to gold. It just ranged up and down within that high level range. In 2008, that spread broke down. It's prior to the actual onset of the bear market in gold, which started in 2011. And that spread collapsed, where XAU index collapsed versus the price of gold all the way down to 4%. Okay. Again, it had lived in a range from 17.5 to 30 plus, and it dropped to 4%. And that occurred precisely at the same time as the bear low in gold and the miners, which was December 2015. Okay. Since that time, at 4%, the spread relationship has firmed, favoring the miners. Right now, they're about 5 something percent. Okay. So they're higher than they were at the 2015 low on a spread basis. And that means they've actually done better than gold has over the last 10 years. Hard to believe, but they have. But they're still at very, very low levels, technically speaking. And when we measure that spread technically, we can see the potential for a breakout, which takes that spread from its current 5+% back up to the bottom of that multi-decade range, which again is defined by multiple lows at 17.5%. Okay, you do the math. If something goes from 5 and goes to 17, okay, it's a tripling. So what we're arguing is that spread relationship is one, dirt cheap, two, has not gone lower over 10 years. It's firmed slightly, but not gone lower. Said, that's it. I'm not going any cheaper. and has the technical potential to go up to the bottom side of its old reality and yet be a triple. So imagine that if you get the acceleration phase in gold, which we expect when the stock market breaks, the movement into the miners could create a tripling of their gain versus what we see in gold going forward. So again, we think the best place to be in the monetary metals are the miners and silver. So yes, gold is the mama and it will lead, but it will not lead in a performance way once these spread relationships shift back to positive.
All right, I think people listening will be excited to hear that both the silver bugs and the people in the gold and silver equities that you still do see that 3x move in the mining
Yes.
stocks.
Mhm.
So nice to hear, Michael. Now, when you look at this, a lot of people think, "Hey, I've spent so long following the sector and I could have made more in US equities." But
No, that's
when
not
you look at
true.
it, that's not true. I know. Yeah,
It's not true.
so
Yeah.
maybe talk to people that feel that way because, gold, if you look at it since the turn of the century, has outperformed the equities. Maybe break down that misconception, Michael.
Yeah, it is. In fact, if you go back, I don't have the numbers in front of me right now. We did it recently, but go back to the bear low in gold, which was 1,050 in December 2015, and go back to the low in the XAU index, the miners. I think that low is like 45. Okay. Right now, in a dip today, it's 151 or in the low 150s. It's been up to 160 plus recently. So, I mean, you've gone from 45 to 160. It's slightly beaten the S&P during that time. It has definitely beat gold during that same time period in percent gains I'm talking about. So even in net price, if you're an investor and not a flincher, okay, and you go long based on long-term technicals or your long-term fundamental assessment. In our case, it was annual momentum, 2 months off that low. We said, that's it, buy gold, buy the gold miners, major bull trend beginning. And simply sat and held it. You're beating the stock market and you're beating gold marginally. Now, in the case of GDX, it's slightly underperforming gold during that time, but the XAU is slightly outperforming. But basically, the miners have definitely matched gold over the past almost 10 years. So I know it causes people to flinch because they look at like the 2020 price high in gold was $2,070. That summer high, the big explosion, after the COVID event. Well, we've gone up almost 50% above there. Okay. Back then, GDX, for example, had a high at 45, and the high recently was 44. So it hasn't even taken out its 2020 high. Right now, it's like 39. Okay. But still, measured from the low in 2015, the miners, despite the fact that they haven't taken out their 2020 high, an obvious price feature, are actually beating gold from an investment grade point of view. And once they come through, and if, I suggest this, and this is simply a price chart, and momentum pre-bears it out. Let me put it that way. Punch up a monthly price chart of the XAU index or GDX going back to the 2015 low and look at what's happened over the last several years, like 3+ years since 2020 high. It's a flat ceiling that has been repeatedly assaulted. In the case of the XAU index, it's posted closes, I think 5 or 6 times during that three-year period, multiple times, either side of 160. And when you look at that price chart, I'm telling you that horizontal ceiling that's 3.5 years wide is not a top. That is not a market top. That is simply a distribution zone that is not stopping the market. It just keeps coming back up and up. And when you see a price chart that looks like that, that is a launch pad for the next move, that so-called ceiling. Well, we're back up there again in the last few weeks, and they're selling it again up there. But I'm telling you, that price chart even tells you this is not the way you top. You go back and look at any major peak in gold or the miners, and you will not see a 3-year wide horizontal quote top. This is a launch pad. And so I think that we're merely building up energy. And I think, again, the key factor is not their technicals, it's the stock market breaking.
Yeah, and Michael, as a chart keeps knocking on heaven's door over and over again, eventually it breaks on through to the other side, to quote the doors.
Yes.
But it's not going to be the ceiling that some people think it is. It, like you say, it's going to be a launch pad. Well, let's also look at the greenback, the US dollar, even though
Uh,
it's a crazy index because it's really the inverse of the euro and the yen and other currencies. Let's look at the dollar and what you're seeing on the momentum charts.
yeah, what we're seeing is this. Of the, let's say, four major asset categories here. We got the bond markets, debt markets. We've got foreign exchange, which is largely the dollar and the large currencies. We've got equities, we got gold and the monetary metal and commodities as well. But when you look over at the forex markets, and especially the big currencies, the dollar index, which is again about 70% comprised of the euro and the yen. So it's really an upside down euro and upside down yen. Okay. But for 2 years now, at least plus. It's been in a very narrow, approximate 10% range from top to bottom. 110 plus, lows around 100. Okay, so a 10% range. Well, that's a very dormant range for the dollar index. If you punch up a chart going back decades and you look at that range, it's asleep. That's really a nothing trend situation. We collapsed from a high at 115 back in 2022, collapsed down toward 100, and since then we've laid in this range. We got up to 110 and we punched out the top of a sub range that we'd created over the last 2 years, which generally was about 107 plus to 100. We punched through and went up to 110, almost got 111. Right now we're back down to 107. So we're sort of back down in that recent, very dormant segment of that range, meaning the breakout didn't hold. Okay, there was a surge up to 110. If you drop the dollar index, our long-term momentum analysis says if you drop the dollar index back down into the lower 104s, so like 3 points below where we are now, 2 points below the low we just saw last week, and you're going to break the thing through a massive momentum uptrend line that goes back decades that says a major leg down. So what we're arguing is we think that's going to occur, that when the Forex market wakes up, or wakes down in this case, you're going to suddenly have volatility out of one of the asset categories that hasn't created any volatility for 3 years now. So suddenly you're going to have a new tectonic plate moving around. And let me put it this way, if you're a European, and I understand there's a lot of foreign investors in the US stock market now, then one of the factors is not just what our stocks do, but what the underlying currency does that you bought them with. So if you bought the stocks in dollars, so if the dollar starts to break, that becomes a factor for you as well, not just the stock market break. And frankly, it looks like the dollar could contribute to scaring foreign investment out of the US market, not just the stock drop in the stock market, but the drop in the underlying money unit. So the dollar could become a volatility factor here, and I think a negative one for the stock market. And, ultimately it's positive for the dollar because the degradation of the money unit is what underlies the glacial moves in gold. But if you look at it recently, go back to 2015, where gold made its low at 1,050, the dollar index was 97 plus. So right now it's up, 10, 11% over a decade. And yet gold's done, doubled and a half. So gold didn't need to have a declining dollar to go up. It goes up on broader issues, not just the dollar, but other forex and the ultimate degradation in the dollar, which is still ongoing. But if the dollar reaccelerates back to the downside and breaks that 104 level, we think it could easily drop down to 80, maybe even 70, back to its lows of the decades. But there's a major drop coming there, and that could suddenly inject a new element into all markets. So it's an important issue.
Yeah, boy, if the dollar got back in the 80s or even the 70s, that would be a big move. And like you say, a currency market that's not been very volatile. So if volatility comes back in and foreign investors are buying US
Yeah,
stocks and US dollars, you got a double whammy. You got a stock market correcting while the dollar's
yeah,
falling. So
yeah,
that
yeah.
that would be wild. What about interest rates, Michael? Because they tie into currencies. How are you
Mhm.
looking at bonds and interest rates?
Well, the bond market, we turned bearish in October of 2020, T-bond futures, 30-year bonds. And at that time, when the bonds were above 170, T-bond futures. They dropped down close to in the low 100s in 2022. That was basically almost a crash event for them. So while the stock market was rising, they were still going up. Okay, but since then, the stock market has continued up since 2020, and bonds have since 2022 laid low. Now remember, from the 2022 low, stocks rose, okay? Bonds didn't. So yields stayed at a chokingly high level. So 2022, 2023, and now 2024, and now into 2025, T-bond prices have been more or less laying in the dirt here at the low levels of that collapse. So yields have not been friendly. But we've noticed that historically, whenever the stock market does peak and generate a downturn, like 2007 top, 2000 top, it was time to own gold and T-bonds. And they both went up together as alternatives to the stock market. I suspect primarily due to major asset managers seeking, that 60-40 portfolio balance, 60% stocks, 40% bonds. And we've called for an upturn in T-bond prices, and it's broken through our level several weeks ago in the 115s, and now we're in the 118s on the T-bond futures. And we think this move could easily carry another 10 points or so, which is significant enough to turn heads and actually take out the price highs we've seen over the last year or two during that congested basing process. So, but I think that's a function largely not of, certainly not the Fed. They don't control the long end. Okay, it's out of their control. It's a function of the perception that we need an alternative place to be. And some asset managers have already been nervous. More, no doubt, are getting more nervous by the day with the recent action in the stock market. And they look to the alternative. And T-bonds are cheap. They've demonstrated for a couple of years now they're not going any lower. In other words, yields don't want to go any higher. And therefore, they seem like they're basing. And so a lot of asset managers will no doubt buy T-bonds as an alternative place of safety. Our argument, though, is yes, it's a tradable advance. It's likely to surprise many people. It could be sharp at times on the upside, inverse of the stock market being sharp on the downside. And I don't think, though, it's a long-term trend. In other words, this looks like a trading situation that might last a quarter or two. In other words, handful of months. Because the very long-term trend of T-bonds, momentum trend, annual momentum trend, which got us negative back in 2020, is fully broken, such that this rally now, if we get it, even impressive as it might be, is not going to alter that major trend. It will merely be a big counter-trend rally in the T-bonds. But it could attract money. And I think it's, again, a reflection of money beginning to move out of the stock market. And you'll see more of it as the stock market breaks more. And I think at that point, bonds will get back in sync with gold, which has been rising over the last couple of years, whereas bonds have been laying in their base. T-bonds tend to follow gold, in terms of an alternative, especially during stock market downturns. And gold has already been rising better than the stock market. And I suspect it will show strength along with T-bonds as the alternative become important to have. And I think we're on the cusp of that. I think T-bonds have begun their upturn.
All right. So both the T-bonds and gold will get the safe haven bid when people look for an alternative, but that's more of a tradable situation in the bonds where on a long-term basis, still bearish on the bonds, but maybe a short-term pop where they get that rally along with gold. I only ask you about the dollar and interest rates and bonds because a lot of algos are keyed off those as input factors, but a lot of people listening probably would like to get your thoughts on the other segment you mentioned, which is commodities. Commodities in general. I don't know which index you look at, Michael, but if you have something you follow that tracks all of them, or if you have thoughts on oil or copper, what are your thoughts on the commodities sector?
First off, commodities have not moved with gold for a long time. There are times when they do, and there are times when they don't. Well, for example, gold bottomed in late 2015. Also, commodities tried to make a low then. Bloomberg Commodity Index, which we like, it's well balanced. Gold turned up and has doubled in a half since 2015. Well, between 2015 and 2020, when gold doubled, commodities still went down. Bloomberg kept going down, not collapsing, just arm wrestling down. And in late 2020, October, we put out a buy signal. Bloomberg then was 70. It went to 140. In other words, it doubled after our buy signal and went up into early 2022. It peaked 13 trading days after that war began, the Ukraine war. Meaning the people who wanted to blame the commodity advance for the rising prices in commodities on the war were totally wrong. The entire advance had occurred well before the war ever even began, including oil. And once the war started, they topped. Okay, so it's a total inverse of the reality that the government wanted us to believe that, oh, it's caused by Russia invading Ukraine. Since then, the commodity index, Bloomberg, has pulled back from 140 down to in the 90s. And for the last 2 years, it's gone dead sideways, either side of 100. It's just like, it's a waste of time to even look at the chart. It was just dead sideways. So what it did, it had a 50% pullback from that rally high in 2022 back toward what had been its bear market low, which had occurred in the summer of 2020, a couple months before we put out a buy signal. That was below 60, by the way, that low. And pulled back 50% and went dead. Now, we've had enough evidence from long-term momentum that it's beginning to turn up. That occurred last month. Yeah, the January close gave us a buy signal. That was just above 100. Right now, Bloomberg's in a pullback. It's 103, 104 zone. If you ever close a month out, and you're not going to do it this month because we're the last hours of the month and we're 103 something, close a month out at 105 or higher, and we argue that the Bloomberg will then launch a second major upwave. Now, at this point in time, if it does that, it will be in sync with gold. Now, if you go back in history and you say, well, how in the world can you have a commodity upturn if the world goes into a decline in the stock markets and has a recession? How can commodities go up? Well, go back to the late 70s and you'll see how. Because we had a major global stagflation, recession, and yet commodities and gold exploded 77, 78, 79 to 1980. And commodities were trailing gold up. They didn't match its gains, but they went up with it. And the stock market was a wasteland. I think we're on the cusp of that again, where that would be a category to participate in on the long side as the stock market breaks down. That would be stocks related to agricultural commodities like fertilizer stocks, tractors, farmland related, chemicals related to farming, and the energy sector as well. I think the energy sector will participate. In that move from 2020 to 2022, oil and natural gas tended to be a percentage leader within the complex. In other words, upside gain was more. I think this time it's likely to be grains. Now, I'm not going to pound the table over that issue, but I think it will be broad. Energy will participate, but I think the grains this time are likely to have a bigger percent move. Therefore, my focus, if I were going to invest in ag stocks, would be ag stocks, fertilizer companies. And you'll see they have no relation to the stock market. So when you buy them, don't be fearful of a stock market decline. They don't correlate at all. They correlate to the Bloomberg Commodity Index. So I think that's another category that will be a positive place to be in 2025. But again, I'd like to see a 105 monthly close on Bloomberg to sort of pound the table and know that that's underway.
Okay, well, we'll be watching the Bloomberg Commodity Index then to see if it does break that 105. An interesting point on the agricultural side, the soft commodities, the grains, that could be the outperformance area for people, even if the stock market's correcting. So interesting points there on the commodities, Michael. And I guess just as we wrap up, why don't you outline what you do with momentum structural analysis for your subscribers so people listening have an idea of how your service works?
Well, we study all four asset categories in our all asset category report. So you don't have a narrow view out this narrow little windshield looking at gold, let's say, or some specific market, especially in this day and age. Unlike prior times in my lifetime anyway, and I'm sure going back further even, where these major asset categories are impacting one another in a very important way now, inversely, in some cases. And I think as that stock market breaks, that is something gold people need to look at, not as a negative for gold, but as a positive injection, because what that will cause, of course, is central banks to go berserk again and monetize debt and so forth and go to the point of exaggeration, which, of course, is what fuels gold. So it's important to look at all four asset categories, and that's what we focus on. We've been doing it since 1992. So it's been a while, and we're very successful at calling major tops and bottoms. And right now, we think we're at a very important point in the ongoing monetary metal move and in the reversal in the stock market. So it's important to look out the side mirrors as well, not just at gold.
It's a great point, Michael. And just as someone that subscribes to your service, I see that you also cover certain segments of it. Sometimes you'll get into financials or healthcare.
Yeah,
You'll break down
yeah.
different segments of the market. So there's a lot in there for people. And we'll put a link to it down below. So for anybody listening, if you want to check it out, definitely click on the link and go over to Momentum Structural Analysis. Michael, it's always great having you on the show. And as always, looking forward to our next conversation.
Thank you much, Chad.